Good morning. It is Monday, October 27th. Zach Howard, Global Morning Market Update. Start the week. Big week on the economic front of potential macro catalysts alongside big earnings from the U.S. mega cap stocks reporting. But we still had that U.S. government shutdown, saving about 40 basis points a week of GDP growth off as long as we continue to shut down. We did have the inflationary CPI BLS data get reported last week, but some of this other data don't know what's going to get actually reported to the market because of people to do the work are still not working. Durable good orders today, new home sales, and then U.S. consumer confidence tomorrow. The big macro event, which markets have already priced in for this week, is the Fed's meeting on Wednesday, and then interest rate decision, policy outlook going forward in the year. As I show you here quickly, like the forecast is for a quarter point rate cut, and you're looking at backdrop of the disinflationary data, the CPI last week gives it free pass on that. So having the government shut down certainly isn't going to delay any rate cuts here, which is what the policy of the U.S. government wants. Lower rates is ability for them to service their deficits that continue to spiral in excess without ability to worry about that. So that helps. And also, I guess, just kick the can down the road to any real reconciliation of this math. GDP for Q3, look back on Thursday. And then core PCE potentially doesn't get reported here on Friday. But like I said, last week we had the confirmation of what similar sets of bond yields, oil lower, gold higher over the last month said it's inflation stopped going up. It's still increasing. It's just not at the rate of change is a disinflationary pressure in terms of that statistic, whether you believe it or not. That's how the market is interpreting it. Month over month, quarter over quarter, year over year, it's a rate of change slowdown across the board on most of those inflationary gauges. As we see now through bond yields in the U.S., lower lows, lower highs in the U.S. 30-year yield, the 10-year, and the 2-year yield. Gold has already been foreshadowing that over the last month, like say, despite this recent pullback in extended periods. But looking at that 2-year U.S. government bond yield, this is really where the central bank is going to go, not the other way around. The market is going to tell the bankers what to do, and the rates of continuing to get cut in, 97% chance for a rate cut of 25 basis points this week, and then the following rate meeting an additional 25 basis points. If you look at the government of Canada's 5-year and 2-year bond yield curve, same thing. The Canadian banker, the central banker parade is out this week as well, and they're going to cut 25 basis points, potentially cut another 25 the following meeting. The market has been telling us that for a couple of weeks here. 2.65% on that Canadian yield. It screams to me that the central bank and the government of Canada are going to get together again and just continue to support fiscal deficits out yin yang. There's no reconciliation of anyone doing math in any of those centrally planned organizations. Mark Carney probably could have potentially a budget defeat that leads to another election. Bring it on the wet tissue that is Carney as our prime minister. Volatility and focus on my work daily. Looking at this cool chart on the left, which overlays to the right. On the right is the MOVE index, which is the volatility reading on U.S. Treasuries. It just continues to melt away. Down 500 basis points on Friday alone, like 68. Crazy low of volatility on the MOVE. And look at the inverse relationship between here, the blue line being the QQQs, aka the NASDAQ 100 stocks, and then the white being this MOVE index. Since the Liberation Day volatility spike, it's been off the races with equities as volatility melts away in all areas of the market. We did see gold volatility double in a matter of 2 weeks, which just goes to show that it's out there. It never really goes away, and it can spur up at any moment. If it can do that with the lowest asset volatility in the world, gold, it can do a lot more quickly in equities if it ever presents itself again. But at the moment, doesn't seem to be a catalyst out there. Despite that, looking through those mega cap stocks, they're going to report here now over the next week again. They're in the blackout window as I talked about. Apple, back to bullish trend. Some of these other ones, Google, back to bullish trend. But look at the CapEx expenditures, roughly $3 trillion globally being spent on the build out of AI, data centers, etc. That's really what's fueling the actual infrastructure, the capital spending of the U.S. economy. It's building out this infrastructure for the railway of 2025. This is what we're doing. Are they going to overbuild? Potentially. But this is driving the economy from a infrastructure standpoint at this point, and these companies have massive balance sheets that continue to use alternative measures, not just their own balance sheets, but special purpose vehicles. Private equity is getting in on these financing of some of this stuff. It's getting pretty frothy out there, but AI related companies have accounted for 75% of the S&P 500 returns since ChatGPT was launched roughly 3 years ago here now in November. What's interesting about some of the metrics, though, about ChatGPT, it has about 2/3 of the AI queries, searches currently of all the other AI competitors, but still only generating about 13 billion revenue this year, I think. 30 billion projected next year. That's just the revenue number. That's not the profitability. So they can continue to throw massive amounts of money building out this. But at the end of the day, when our shareholders are going to say, well, where's the return on all this CapEx building? Yeah, it's going to change the world. It's going to make companies, countries, people more efficient, but as a return to your shareholder, when does that show up? US, the major data center build out combined of all other countries currently far exceeding here over 5,400. Where's the power going to come from? That's the question. Natural gas, alternative uses of energy, nuclear. Yeah, there's a pro administration in there for all that, but you just can't flick a switch or put a shovel in the ground and turn all that power on. Power costs are going to accelerate significantly in the years ahead because of this demand, no doubt about it. Really cool meme here on the right from Lee Shrub. But back to the what are you paying for when you're investing in these data centers and these AI build outs today? What's the actual cash flow? My favorite metric of evaluating a company is the free cash flow yield. And if you look at the S&P 500 historical low here, 2.35%. If you're just looking for free cash flow yield and what you're getting from a market cap standpoint on the actual cash flow of those businesses, it's not there. You're buying momentum. You're buying the trade of the day. Whereas you want to look at boring, old school businesses, revenue minus expenses equals profits. The gold miners are the ones to look at. They continue to smoke it. They had the highest free cash flow yield out there of any sector. And in Q3, they did the strongest, 47% roughly in the gold equities. Copper equities really appealing to well here with $5 plus copper per pound. Technology, yeah, it's had a great run in Q3, but let's be real, just looking at the math. Gold and copper equities smoked them. And I just see that trend continuing from an old school analyzation of what is the free cash flow yield on a company, on a sector. And that's what I got. Have a great one. See you soon.